Hey everyone, happy Tax Tuesday. It's 10 o'clock. I'm a little bit late. Sorry, having a little tech issues over here. But welcome to Tax Tuesday. My name is Heather Ryan, and I am the tax queen. If you're not familiar, each Tuesday, the first Tuesday of every month at 10 a.m. Mountain Time, I go live and answering your questions. I typically start with questions that have been submitted online, and then if I have time, I will do some live questions as well. So if you're here, please drop a note, drop a question if you have it, and hopefully I can get to answer some of them live today. Funny enough, we're in the midst of tax season, and I did not get too many questions prior to today's live session. So I am going to go through them quickly, and we'll get to your questions if you have any, and otherwise we'll just keep this short. So first question I have is, I know I can deduct health insurance costs and out-of-pocket expenses, but I pay separately for dental insurance. Can I deduct that as well? And is it taken, where is it taken? So this is kind of a two-part question to me. If you're self-employed and your business has a net profit, it makes money, there is a deduction called the self-employed health insurance deduction that is for traditional health insurance, and it can include dental insurance. So you would take that as a self-employed health insurance deduction. If you're not self-employed and you get to itemized deductions, then you would take that as part of medical expenses on the itemized deduction area. So I hope that answers that question about deducting health insurance costs. And yes, you can take out-of-pocket costs as well. And you can even take mileage. So if you're driving a lot, like if you have a surgery and you need follow-up care and you're driving a decent amount for that, be sure to record mileage because that is allowed if you can itemize. So again, medical expenses are taken as part of itemized deductions, or if you're self-employed and have a net profit, you can take it as a self-employed health insurance deduction. So not the actual medical expenses, just the insurance, and dental insurance qualifies as well. Let's see. So question 2. My husband and I have an LLC partnership, and I saw that the deadline for Form 1065. So really, I'm just going to turn this into partnership. So a multi-member LLC is by default a partnership. If you're not aware, the partnership has a separate tax return that you must file, and that tax return deadline is March 15th. It is earlier because the information used on the partnership return is then used to prepare the partner's individual tax returns. So that's why it is earlier. Usually there is not a tax due with a partnership return. So all the tax is paid through your personal return or the partner's personal return according to, their partnership percentage ownership or distribution amount, according to whatever agreements that you have with your partners. If it's a husband and wife, it can be 50-50, it can be 80-20. There is no rules. You set those rules. So hopefully that answers that question. Again, if you're joining us a little bit late here, please feel free to leave a comment with your questions. I will try to get to them live. I had very few previously submitted questions. So just be aware, I'm happy to answer some live questions. Otherwise, we're going to keep this short. So I only have one other question, and it, funny enough, is also related to partnership or single member versus multi-member LLC. So I do find that a lot of times questions kind of overlap. And this is definitely one of those times. So this person has a single member LLC, and her husband is now helping her with the business. Should we add him to the business or, pay him separately or things like that? This is kind of a loaded question, and there isn't one right answer. It is, individual situation. There is no wrong or right here. I would really look at your individual situation. If it's what the profits are. I don't see the need necessarily to add him. Just because it's your business, like it's one of your business, doesn't mean the other person can't help. You could pay them with W-2 wages if you want. I would steer clear of paying them via 1099 because now you're creating a second business, essentially. You can add them and become a partnership, depending on income levels. If it's doing really well and you're, at 75,000 or something of net profit, maybe you want to add them and be an S Corp, or you just want to elect S Corp and pay them a W-2. So you can see there's a lot of different options there. And I don't know necessarily which one would fit your situation best. So that's a really difficult question. I'm trying to be very general here because I don't know the rest of that situation. So if that is you and you are not sure to add, a husband or a wife or a partner to your LLC, definitely reach out to a tax professional and about your specific situation. It's based off income level, there's a lot of moving parts there that we would want to look at. So that's my recommendation there. And yes, that concludes all of the questions that I got prior to today's going live. This is probably the least amount of questions I've had, and I wasn't expecting that because we're in the midst of tax season. I thought people would be having lots of questions. So I do see one that came in live here. Currently, my wife and I are RVers, but we're not full-time. Residence is in Colorado. Mine too. Awesome. We have home base in Colorado. If we sell our home in Colorado and become full-time in 2023, is there any tax advantages of being full-time for only part of the year? No. There's really no advantage as far as taxes are concerned for being a full-time RVer. The advantage of the lifestyle, the freedom, if that's what you're looking for, removing the expense of a home and upkeep, and that's an individual choice. So there's really no advantage of being a full-time RVer for tax purposes. As a matter of fact, I actually find it the opposite. So if you have a home base and you travel part-time, especially if any of it is for business, you actually have an advantage. And if you still have that home base, you qualify for home office and things, which you disqualify for the minute you become full-time. So yeah, hope that answers that question. Thanks, Randy, for joining us live. And then someone says they submitted a question regarding deductions of mileage and campsite fees. I don't think I saw that question. If you wanted to repeat it here, I'm maybe happy to answer some questions on it. I either missed that or it just didn't come through. Currently, we're full-time. We own the land with our daughter who lives in the house. We started a business. It is RV weighing going from rally to rally. So can I deduct the mileage to the rallies? I would say yes, you can deduct mileage for sure. The campsite fees, I would question. But mileage definitely makes sense in that situation. You are going basically from conference for business to conference. So I would definitely say the mileage would make sense there. But just be careful because like if you go, I'm just going to use an example. Like if you go to Phoenix to Vegas and you stop somewhere in between, that's personal. And so like that's when that mileage kind of gets sticky. So if you drove straight from Phoenix to Vegas, no stops, straight through whatever that mileage is, and you're getting to Vegas for a conference or a rally, for sure, you should be able to take that mileage. But again, if you stop anywhere in between, that's personal use. It's a very fine line. It's a very gray area because an RV can be used as like a home, right? It has sleeping quarters. You can eat in it. You're watching TV. You're doing personal things in there as well. So that's why it gets to be really sticky. It gets a little easier to explain yourself if you do have a home base. I think I was just talking about that in the previous question, but yeah, so hopefully that helps clear that up a little bit. And some of that is also your risk factor. If you have high mileage, it is a red flag for sure. So yeah. That's my suggestion. Because you're using the RV personally. That's why you cannot take campsite fees. I almost never suggest taking campsite fees as a business expense. Yeah. But again, it's your risk factor. If they are kept to a minimum, it's possible that you can take them. There's no, yes, you can take this. No, you can't. It's a very gray area. It's what you're comfortable with and the risk you're willing to take. But I caution, I mean, there are court cases where the RV mileage and things were not allowed. So just make sure you have a really good log of why you're driving. And I would even use an app like MileIQ or QuickBooks. If you use QuickBooks for bookkeeping, they do have a mileage function, and it will literally record every drive you take using that truck or RV. And you can swipe one direction to mark it as business and the other direction to mark it as personal. And that way it's recording your mileage. And it's really a great log. You need that electronic log in order to take any mileage. Without it, it won't be allowed. So I hope that answers that question. Anybody else have any questions? Well, otherwise, I'm going to keep this short. Again, I thank you all for joining me, and I'm, happy tax season. So otherwise, I will see you on the next Tax Tuesday, which is April 4th at 10 a.m. Mountain Time. Enjoy the rest of your week and month, and I will see you in April. Thanks a lot for joining me.